Okay, then we've got objective of general purpose financial reporting. Very simple. We discussed already. The primary users of general purpose financial reporting are present and potential investors, lenders, and other creditors who use that information to make decisions about buying, selling, holding equity or debt instruments, providing or settling loans or other forms of credit, or exercising rights to vote on or otherwise influence management section that affect the use of entities' economic resources. Now, that's like a clear, long, a rather long statement, you know. The financial statements are prepared for all for groups of all stakeholders, okay, and you know that stakeholders are all those parties whose interests are within the activities of, or within the decisions or activities a business performs. So it has, I mean, you've got employees inside, you've got investors, future investors, you've got suppliers and creditors and everyone, and the purpose is to provide them the financial information so that they can take their economic decisions. So the primary users need information about the resources of the entity, not only to assess an entity's prospects for future net cash inflows, but also how effectively and efficiently management has discharged their responsibilities to use the entity's existing resources. That is the concept of stewardship. Yeah, okay, I tell you something here before I move further. Sometimes you prepare, now that is a little bit different concept, but it will help you to understand this particular uh, how to say slide. Listen, when you see, for example, Kamlesh, you have given me or you have shown me your financial statements for 2020, okay, or now 2021 is not done, so 2020. So in 2019 I see the numbers were very good. In 2020 I see the numbers are also very good. Do you think that 2021 will also be good? Numbers, financial statements do not provide you sufficient information to take decisions. They do not provide you. I can interpret financial statements very well. I read numbers very good. I know the numbers, but you know what? Numbers are not the only things. There are some other facts. You know what? Maybe after 2020, there is some technological change which has happened. So the technology which your company has been using is becoming obsolete. So it was doing very good historically in 2017, 18, 19, 20, but in 2021, it may not be doing very good because of the change in the market, because of the change in the technology, or the very least, because of your key management personnel has changed. Maybe in the last 6 months, your company CEO has resigned, and three more key personnel. All of the things are same. Your market is same, your company is same, your product is same, everything is same. I'm taking away your 4 key personnel. It is possible that the business may go down. You remember that when this Apple CEO Steve Jobs became sick and people knew, I mean, there was a rumor in market that he had cancer and he was like, he probably would not survive. Immediately the stock price went down because people knew, although Apple is such a big giant, but that one person, it has impact in that business. So what we say that there are 2 things. One, the resources in the business, and how these resources, how effectively, efficiently these resources are being used. So when you see financial statements, you are seeing not only the resources of the business, what business has, the assets and liabilities and the net assets, but at the same time, you are also seeing that how the management is discharging their duties and responsibilities in making the best use of these resources. This is called stewardship. And that's why we do interpretation of financial statements and we make some numbers and ratio analysis, etc. IFRS framework notes that general purpose financial reports cannot provide all the information that users may need to make economic decisions. This is what I was telling you, that the framework itself, it says that the financial statements which we are preparing, they are actually comprehensive. They are I mean, they are all inclusive, they include all the information, but still it is, they are not enough, they are not sufficient to make the economic decisions or financial decisions. You take the financial statements, but with, I mean, having financial statement with you, and then you analyze other factors as well. Like I told you that, okay, the numbers are very, I mean, the numbers look great, but in last 3 months the technology has changed, the government has made some new laws, maybe some new competitors are entering into the market, maybe the economic recession is coming, is going to hit us. So these financial statements are based on past data, historical data. They only tell you what happened in past. Based on that, you try to predict future, but it is not sufficient. You need to, uh, collect more information. Take this information as a basis and then collect more information and then make your economic decisions about future. So information about the reporting entities, economic resources. So economic resources and claims. Economic resources are your assets, claims are your liabilities. It's very important to know what you have, but at the same time, it is even more important to know what you owe. And it is very important to know how did you get these resources. Okay, you come and tell me that I've got 10 million worth of asset. Okay, now that looks very interesting. You've got 10 million, 100 million of assets. My question is, how did you buy those assets? Where did you get money to buy those assets? How did you finance those assets? So when I see that you've got assets, on your balance sheet, your assets are 100 million, but then you've got 80 million of liabilities standing against those assets. So your worth is only 20 million now. Okay, 100 million assets, which are resources, 80 million are claims against those assets, which are liabilities. Net worth is only 20 million. So we need to see economic resources and we need to see the claims against those economic resources. And then we need to see the changes in economic resources and claims. Like as compared to last year, how much your assets have grown and how much your liabilities have grown. Maybe the liability, the gap, the difference between the assets and liabilities is increasing or decreasing. Maybe in last year, from this year to last year, your assets have grown only by 10 million, but liabilities have grown by 15 million. So where is that 5 million in, that probably is the loss which you have made. So you need to see how liabilities are growing or how assets are growing. And financial performance reflected by accrual accounting. We use accrual based accounting. I'm sure that you guys very clearly know accrual based accounting means that it's different from cash based accounting. So accrual based accounting, it tells you to record the transactions to the period to they belong, and it's not about receiving or paying cash. So transactions are not recorded when cash changes hand. In fact, the transactions are recorded when to the period to which they actually belong. Financial performance reflected by past cash flows. Remember, when I say there are two words, financial performance and position. And sometimes students just take it like, okay, financial performance, very casually, but it's a very specific term. Financial performance means ability to make profitability. When I say financial performance is good, it means that profitability is good. Now, remember, a business has two things, performance and position. Financial performance is income statement. Financial position is balance sheet. Financial performance means ability to make profit. Financial position means your assets and liabilities. So it is possible that your financial performance is good, but position is bad. Or your financial performance is not really good, but position is strong because you've got a lot of assets. If you see, there are many government departments who have got huge assets. Huge assets they have, a lot of land and offices, premises, billions of assets. Their position is very strong. They are not going anywhere. They're not going to go bankrupt. Performance, probably there is nothing. They don't make a lot of profit. Some of them are even in losses. Some of them are in losses. So performance is bad, but position is good. So we need to see both of them. And changes in economic resources. So this first thing, actually, if you think about this one, economic resources and claims, this is about balance sheet. because here I'm talking about assets and liabilities. And this is, I'm talking about your income statement, because here I'm talking about performance. Performance means profitability. Profitability means income statement. Okay. So uh, changes in economic resources and claims not resulting from financial performance. Now, now that's very interesting. You know what? Your balance sheet changes because of your income statement. For example, if in this year, let's suppose I have my balance sheet, I put it there, I don't touch it. And then income statement is my 1 year, the reflection of my this year activities. So I buy, I keep on buying and selling goods. And end of the year, if I make profitability, if I end up in profit, so probably $1 million. That $1 million profit from income statement is transferred to the balance sheet. And what will happen in balance sheet? Equity side 1 million will go up, equity, because your profit goes to retained earning. Retained earning is part of equity. And then this profit probably is in form of cash, or maybe it is in form of receivable or inventories. Asset side will go up. So your balance sheet is actually adjusted, your opening balance sheet and closing balance sheet. The difference between opening and closing balance sheet, or the last year and this year balance sheet, the difference is due to your income statement. Okay. If you don't do any business, you don't touch anything, your opening balance sheet on 1st January and closing balance sheet on 31st December will remain same. The changes, the movements in the balance sheet, they are the result of your income statement. If your income statement is good, your balance sheet will move in a better way, or it will be improved. If your income statement is bad, which means you are making losses, your balance sheet will also go down. So here we say that changes in economic resources and claims not resulting from financial performance. So
है
like this is what I was telling you. This is resulting from financial performance.
चल
What I
मैं दे
was
रही हूँ
just explaining you, this is financial performance, which means income statement. So usually, generally, it is assumed, theoretically, principally, it is assumed that balance sheet changes because of the changes in income statement. But now this sentence, it says not resulting, because there are some other you know how to say, changes as well in your balance sheet, which are not coming from income statement. For example, you take a loan. When you take a loan, your assets increase, your liabilities increase on the balance sheet. It is not coming from financial performance, but the statement of financial position. Your resources have changed because you purchased an equipment on credit, on leasing. So assets go up. Similarly, your liabilities also will go up. Maybe you have issued some share capital. So cash has come in, which is asset, and then equity has increased, but it has got nothing to do from your income statement. So we say that statement of financial position will change either from the factors coming from the income statement, which means financial performance, or from some other sources. And we need to show both of them. We need to show both of them. Then we talk about qualitative characteristics of useful information.